Welcome to Chapter 14 of Essentials of Healthcare Finance, Cost, Concepts, and Decision Making. The purpose of this chapter is to give the reader an ability to identify and use relevant cost information in financial decision making. Costs are classified by their traceability, direct versus indirect, management control, controllable versus non-controllable, relation to budget, meaning budget versus actual, relation to time, meaning avoidable, sunk, incremental, and opportunity, and relation to activity, meaning fixed, variable, and mixed. These classifications are used to improve the decision-making process by precisely defining cost to make it more relevant to decisions. Regardless of the classification system, however, in most situations, the total value of the cost is the same. Because, in most cases, different concepts of cost simply slice total cost in different ways. There may be underlying relationships among the various concepts of costs. For example, direct costs and controllable costs may be related. In many situations, there are standard rules of thumb that may be used to relate cost measures. An understanding of fixed and variable costs is a crucial element in making such decisions. Fixed costs are costs that do not vary in total, but vary per unit over the relevant range. Variable costs are costs that vary in total, but do not vary per unit over the relevant range. The relevant range is the range of activity within which the assumptions about the cost behavior are valid. Our learning objectives are to discuss ways to classify costs, discuss 4 major categories of costs, explain what cost behavior is and identify 5 types of cost behavior, differentiate between controllable and non-controllable costs, discuss 4 types of costs relevant when considering alternative projects, and explain the role of direct and indirect costs in the costing process. Additionally, we will look to describe the 3 methods of cost allocation, establish the importance of semi-variable cost function, calculate estimated fixed and variable costs using one of the described methods, calculate break-even and the volume necessary to achieve a desired net income. Cost information is produced by the firm's financial accounting system. It can be used by department managers, third-party payers, and planning agencies. Cost objects are products, which are outputs and services, and responsibility centers, for example, the department. Costs can be classified according to the decision maker's specific need. Major classifications of cost include traceability to the object being costed, management responsibility for control, relation of cost to budget, relation of cost to time, and behavior of cost to output or activity. Direct costs can be specifically linked to a given product or service. For example, direct labor, salaries, supplies, or rent expenses. Indirect costs are not easily traceable to a product or service, but support production of a product or service. For example, any administrative overhead, depreciation, or employee benefits. Cost behavior describes the cost variability in relation to output or activity. The measurement of cost behavior is influenced by the department's classification of cost, for example, direct versus indirect. 5 major categories of costs are classified by their behavior. They are variable costs, fixed costs, or mixed, which includes semi-fixed costs, also referred to as step-fixed, semi-variable costs, or curvilinear costs. Variable costs change proportionally as output, volume, or other activity level changes. The activity is a measure of what causes the incurred variable costs. For example, direct labor hours, or discharges, or patient visits. Consider the following example. All supply costs are variable, so for each unit increase in relative value units, RVUs, supply costs increase by 50 cents. Fixed cost. Fixed costs do not change or vary in response to changes in activity. They are a function of time, not output. So consider the following example. Fixed cost behavior for the depreciation cost of the lab. Each month, the depreciation cost is $160, irrespective of output levels. Semi-fixed or step-fixed costs are costs that change with changes in output but not proportionality. It might be considered variable or fixed depending on the size of steps relative to the range of volume. Consider the following example. Salary cost of the lab is semi-fixed. Assume for every additional 2,000 RVUs, one additional full-time employee, FTE, must be employed. Within each range of 2,000 RVUs, salary costs will be fixed. Semi-variable costs include elements of both fixed and variable costs. There is some fixed requirement per unit of time, regardless of volume. However, there is also a direct proportional relationship between activity and costs. Utility costs are a good example of this concept. Variable costs do not always behave in a strictly linear fashion. However, within a relevant range, costs can be approximated with a straight line. The relevant range is the range of activity within which the assumptions about the cost behavior are valid. Managers should understand that assumptions about any type of cost behavior may not be valid outside the relevant range. To evaluate management control processes, costs must be assigned to individual responsibility centers. Controllable costs can be influenced by designated responsibility centers within a defined time period. Main approaches to designate controllable costs consist of identifying them as total costs charged to the department, or they may be limited to direct costs, or may be defined as only those costs that are direct and variable. Regardless of the chosen method, it should be applied consistently across departments. Decision-making involves selection among alternatives. Certain costs are important to the process of selecting among alternative decisions, including avoidable costs, sunk costs, incremental costs, or opportunity cost. Avoidable costs can be eliminated or saved if an activity is discontinued. These costs will remain only if activity continues. Variable costs are usually a subset of avoidable costs, and some fixed costs may also be avoidable when large changes in volume are considered. Sunk costs are retrospective costs that have already been incurred. Sunk costs are unaffected by the decision under consideration, and typically sunk costs are a subset of fixed costs. Incremental cost represents the change in cost that results from a specific management action or decision. Incremental costs are similar to marginal costs, or the cost to provide an additional unit of service or product. Therefore, incremental cost refers to the change in costs that result from a management decision or action that increases volume. Opportunity costs are the values foregone by using a resource in a particular way instead of the next best alternative. Consider the decision to expand a nursing home. Historical cost of land is $1 million and the current market value is $10 million. The opportunity cost of using this land to expand the nursing home is represented by the next best alternative, which in this case is selling the land for $10 million. Cost in relation to budget. Budgeted costs are the amount that has been planned or authorized to be spent in a specific category for a specific purpose. The actual cost is the amount that is spent in a specific category or for a specific purpose. Cost allocation is the process of assigning pooled indirect costs to specific cost objects. Uses an allocation base that represents a major business function. An allocation base or cost driver is a volume metric that is used to allocate costs based on its relationship to Y costs incurred. For example, square footage or the number of FTEs or direct labor hours. The cost of indirect non-revenue departments needs to be allocated to direct revenue departments for decision-making purposes. For example, reimbursement may be based on the department's full costs. For example, both direct and indirect costs. Similarly, pricing decisions and financial return evaluation should be based on full costs of a specific program or service line. Equity is critical in allocating indirect department costs to direct departments. Cost allocation should reflect the actual indirect costs incurred by the direct department and motivate managers of direct departments to reduce costs. To allocate indirect costs, two decisions must be made. One, selection of the cost driver or basis of allocation, and two, the selection of the method of cost apportionment. These methods include the step-down method, the double distribution method, or the simultaneous equations method. The step-down method is used by most healthcare facilities. The idea here is that the indirect department that receives the least amount of service from the other indirect departments and provides the most service to all other departments allocates its cost first. Similar analysis is conducted for the remaining indirect departments. For example, consider a hospital with 4 departments: laundry or linen, housekeeping, radiology, and nursing. The first step is to decide which department provides the most service to the other for each department. Assume the laundry linen department provides the most service to the other departments, so their costs, $15,000, are allocated first. The cost driver for laundry linen is pounds of laundry used. Of the 100,000 pounds of laundry used, housekeeping uses 5% and is therefore allocated $750. Which is 15,000 times 5% of laundry linen's direct cost. Radiology similarly uses 5% and is also allocated $750. Nursing uses 90% of the laundry and is allocated $13,500. Now, the total direct cost of housekeeping to be allocated to radiology and nursing is $30,750. $30,000 of housekeeping's original direct cost plus $750 of allocated laundry and linen. Housekeeping is allocated to radiology and nursing based on the numbers of housekeeping hours used. Therefore, radiology is allocated $9,711 and nursing is allocated $21,039 of housekeeping costs. The full cost of the radiology department, including indirect costs, is $145,461. The full cost of the nursing department is $304,539. It is important to remember that in the step-down method, the order of department allocation is important. In addition, the allocation base or cost driver can also create differences in cost allocation. The double distribution method is a refinement of the step-down method. Instead of closing an individual department after allocating its costs, it is kept open and receives the costs of other indirect departments. After one complete allocation sequence, the former departments are closed using the normal step-down method. Simultaneous equations method is used to calculate the exact cost allocation amount. Mathematically correct allocations are computed through a system of equations. Consider the previous example. Laundry cost equals $15,000 plus 0.05 HC. The housekeeping cost equals $30,000 plus 0.05 LC. Radiology cost equals $135,000 plus 0.05 LC plus 0.30 HC. And nursing cost equals $270,000 plus 0.90 LC and 0.65 HC. Cost functions can be estimated using a variety of methods. The four main estimation methods we will consider here are visual fit, high-low, semi-averages, and regression. In the visual fit method, the data points are plotted on a graph. A straight line is drawn through the points to provide the best fit through the points. The slope of the line can provide an estimate of the cost per additional films. The visual fit method is a good first step in any method of cost estimation. The high-low method is a technique used to estimate the variable and fixed cost coefficients of a semi-variable cost function. The variable cost parameter is solved first. Change in cost from highest to lowest divided by the change in output. The fixed cost parameter is solved next by subtracting the estimated variable cost from total cost. The semi-averages method is similar to the high-low method in the mathematical form. To derive the estimate of variable cost, the difference between the mean of the high-cost points and the mean of the low-cost points is divided by the change in output from the mean of the high-cost points to the mean of the low-cost points. Fixed costs are solved in the manner identical to that used in the high-low method. Multiple regression method is an extension of simple linear regression and is used when the dependent variable, for example cost, is caused by more than one factor. For example, shipping costs may depend on both the number of units shipped and the weight of the units. It includes multiple dependent variables in the regression analysis. The break-even equation can be used to determine price, volume, fixed costs, and variable costs per unit if each of these other factors is known. The break-even point is the volume at which total revenues equal total costs. The break-even equation for volume in units is volume equals fixed costs divided by price less variable costs. The results of a break-even analysis are often presented on a break-even chart, which displays total costs, total revenues, and volume. The distance between the total cost and total revenue lines on this chart represents the amount of profit or loss the service is experiencing at any particular volume of service. An alternative form of this chart portrays just the difference between the total cost and total revenue line, net income. Previous break-even analysis is based on a single-payer system. In healthcare, there is usually more than one payer or purchaser of services. The main categories of payers are cost payers, fixed price payers, and charge payers. Break-even formula for the three-payer situation is shown below, where the individual variables are variable cost per unit of output, fixed cost per period, targeted net income, internally set price that is paid by charge payers, externally set price paid by fixed price payers, proportion of cost payers, proportion of charge payers, and proportion of fixed price payers. computation of marginal profit is one of the special applications of the break-even formula. It determines how sensitive profit is to possible swings in volume.